Welcome to the market observations call for the week of October the 10th. Just a reminder, this replay is for advisor use only. Recapping last week, we saw stocks marginally higher, snapped a 3-week losing streak for the S&P, had very strong gains earlier in the week. That was following a sharp decline in job openings. Another case of bad news is good news, though that then very quickly reversed course. We got some slightly better than expected labor data later on in the week. Non-farm payrolls beat expectations. Unemployment fell to 3.5. We saw continued wage increases. Wasn't necessarily an overly strong, encouraging labor report, but nothing in it to suggest, Fed would potentially pivot. As a result, as a theme we've seen play out through the entire course of this year, the rates up and stocks down. As a reminder, no Fed meeting this month. Meet again in November. Expectations for another 75 basis points, followed by another 50 in December. Then the question really becomes, where do we go from there? Does the Fed wait and see? Does the Fed continue to hike, or does the economy deteriorate to the point that the Fed feels they now have to take action and emphasize more of the labor market versus stability of pricing? Turning to some other economic data, did get a stronger than expected services ISM reading, somewhat of an encouraging sign. Certainly, though, confirms that consumers shifting away from spending on goods to more services, things like entertainment, travel, dining out, etc. I did get a slightly softer than expected composite PMI. Keep in mind that is the leading indicator, so it talks about where are we going from here. That does suggest may have some early signs of economic weakness here. Again, nobody's questioning that global growth is slowing. Really, though, the focus is where does it go? And then finally, a key piece of or part of the economy that we get a lot of questions on is real estate. That's something with mortgage rates north of 7. The affordability is near all-time lows. Granted, we haven't really seen a significant decline in prices. Activity is way down. Prices have remained somewhat steady. Granted, if they did fall, that would have a positive impact on CPI, but certainly a negative impact on the overall economy. Something continue to watch very closely here. Again, expectation is for prices to revert back at some point, but not to the extent of global financial crisis where that had a much, much bigger impact on the overall economy. The biggest headline last week was the OPEC, Organization of Petroleum Exporting Countries. They announced they were going to cut production by 2 million barrels a day. That has drawn a lot of political criticism. Certainly was viewed as a snub to Biden, who's doing everything he can to get gas prices under control leading into the midterms. But that also, by and large, has tremendous inflationary impacts with less supply and stable demand, going to put upward pressure on prices. Turning to the geopolitical front, 2 negative headlines there. In China, continue to get some additional cases of COVID outbreaks. That continues to spur the understanding that no end in sight with respect to those lockdowns. As a result, do believe that region is for the most part uninvestable. Granted, economy, the GDP is doing better than expected. Assuming you could truly digest or accept those figures that are published, but as a whole, for the catalyst to enter that market, need to see a meaningful change, either on getting COVID under control or them adjusting their policies. The bigger headline, though, one that is somewhat worrisome, the Russian news media, you saw a very strong shift in their narrative. They talked about how their military has let them down. Obviously, there is nothing published on Russian news media that doesn't get the Kremlin's approval. And heard a Bloomberg opinion that went into a little detail here, and the author was making the argument, if Putin somehow willing to rally the Russian people behind him by suggesting, hey, the military has let us down, but we need to do what we need to do in order to maintain our prestige and our strength. Does that somehow open the door for some of those escalations that he has continued to mention? You saw Biden in a public speech last week come out and mention that he expects Putin to move forward with nuclear weapons. That was something, if you recall, very similar leading into the Russian invasion of Ukraine. Biden got out ahead of that. Obviously, it did ultimately come to fruition. So something to continually monitor. humanitarian impact aside, that would certainly have a very negative impact, if we saw a nuclear escalation. Shifting gears to the week ahead, retail sales data on Friday. I think that's going to garner a lot of attention. Again, we talked about one of the strengths of this economy is consumers, in the face of high prices, have continued to go out and to spend money. At some point, though, as we see that excess savings steadily being drawn down, some point that impact will be felt and translate to consumer weakness. Question is when. So a lot of focus on this Friday's report, but headline undoubtedly will be inflation on Thursday. Expectations are for modest increases. Again, unless we got a sharp figure one way or the other, I think it would still be status quo at this time. Lastly, from a positioning standpoint, still continue to favor more conservative allocation on the equity side. I think as long as the Fed is still hawkish, the market can really only go two directions, either sideways or down. Again, need to see that meaningful shift in their policy, before you'd have confidence in a sustained rally. With respect to implementation, still favor domestic over international, defensives over cyclicals, with the sole exception being the energy space. That's a sector, despite the success that it's had year to date. Again, when we think about more buying with respect to energy, again, U.S. government replenishing the SPR, that's actually an area that I think can boost demand from where it is as well. Really, the only sector that is forecasting earnings upside surprises or positive guidance. Again, going into the earnings season here, which is going to be very telling on the next move for stocks. The other thought when we think about bond allocation or bond positioning, do still recommend being underweight duration. Again, not sure that the Fed has reached the terminal rate just yet. That will be very telling at some point. Do think treasuries will be very attractive, not there just yet. And then one other interesting piece, we talk about this in the Q3 commentary, is respect to credit. That's actually a sector that's held in there very well. The credit spreads have not blown out, nearly to the degree that, you would have expected given the equity market volatility. And there's obviously saying that the bond, traders are the smartest folks in the room. And so interesting that bond market has not forecasted a recession, when we think about the fact that the equity market has already priced in, a fairly mild recession at this point. Again, something that we talk about a little more detail in the Q3 commentary. I will include that in this week's note as well. That's all for now. As always, please let Michael and I know if there's anything we can discuss in more detail. If we don't connect, have a great week. Take care.